All right. I think we are live and good to go. How are you, sir?
What's going on? I'm good. How are you?
I'm doing okay. So, just as we were talking about, we try to do every month do a real estate ask me anything on a different topic. So tonight, wanted to pull you in to talk about the fun, exciting, sexy part of real estate, and that's the financing end of it.
The
I know I
part
joked.
everyone hates the most.
I know I joked before is I get the good part of the industry. I get to look at the pretty houses. I get to meet the people, and you get to work all the numbers on the back end.
And push paper. Exactly. Everyone wants to buy a home. No one wants to buy a mortgage.
You got it. For everyone who doesn't know, this is Pat Staffa with AnyMac Home Mortgage. Pat and I have been partnering to work with clients past couple years. Actually, just looked it up. We've worked with at least 36 mutual clients. So helping buyers get into their homes. So that's been first-time home buyers, move-up buyers, downsizing buyers. A couple of unique programs that we're going to touch base on as we go through this evening. So Pat is definitely a great resource, particularly on the first-time homebuyer end. Pat is great on the education and the explaining part of a very complicated part of the real estate process. So definitely share that. So I want to start off with the number one big question that everyone loves to ask mortgage lenders and real estate agents. How are real estate mortgage rates?
Well, rates, there's no secret. The media paints a pretty descriptive picture of how high they are. So we're in the upper sixes, approaching 7% now. The past week and a half hasn't been too friendly towards rates overall. So we're not out of the woods yet. May is here. That was a very important date as far as inflation is concerned. But with everything else going on in the economy, it kind of put that on the back burner as far as inflation is concerned. So rates are still high, still projected to drop at some point this year, but no one knows exactly when. Uh, we're probably projecting middle to end of fourth quarter at this point.
Gotcha. So if rates are going down, buyer calls you up and says, "Hey, I heard rates might be going down in the future. Should I hold off on buying my house now?" I know I certainly have an opinion on that, but what's your thought?
No, don't hold off. You should have bought yesterday, basically, is the answer, right? Regardless of rates, there's still a lot of competition out there. And just on my side, in my office, we're seeing an average of 10 plus percent bids going over ask. So 10% over asking minimally, covering massive appraisal gaps and still doing all those creative things that we did during COVID. So the long answer to this is that we are probably worse than we were during COVID times as far as the market is concerned. A lot less inventory, a lot more competition, and it's just fierce out there.
You got it, and I'm definitely feeling that working with buyers as well. I think that's where you and I are working hand in hand. Working with clients. A lot of times we're in a group text. You, me, the two buyers that we might be working with, and that's where I feel like we each bring something to the table there. Where I talk a lot about that inventory, the pricing, the price appreciation on houses that we're seeing, which is certainly unseen in the past couple of years. And then you get to be the numbers guy, the rates on that back end. So, like you said,
Exactly.
definitely seeing that house appreciation over time. Houses are increasing in prices. It comes down to supply and demand. I know I've talked about that in several past videos.
Simple economics, right?
You got it. We say simple, but I think every time we talk, I'm getting a little bit more of an economics lesson too. So, no, like everyone else, I've learned a lot about inflation and the Fed and everything else that goes into that a little bit more each time.
Exactly. Yeah, it's a complex situation to a simple dynamic, if you will. Economics is fairly simple the way the reasoning is, but there is a lot of complexity in today's real estate market and the way we transact on a day-to-day basis. It's not what any of us have been used to in our careers thus far.
No, certainly been a different time. So with home prices appreciating, the best time to buy real estate is yesterday. The second best time to buy real estate is today.
today.
But rates are high. You said rates might go down in the future. So why should I buy a house now if rates might be lower in the future?
That's a great question. So basically, you could always refinance to lower your interest rate. You cannot refinance to lower your principal balance. So what's going to happen is, and this is just my opinion, right? And probably your opinion as well. Once rates drop, there's going to be a lot of folks that have just been waiting for that moment to enter the market. Now you have everyone that's been shopping and everyone that's waiting to shop after that same property, right? Because there's only so many homes one buyer could chase. So you have a multitude of buyers going after that same property. So what's going to happen at that point? It's an auction now. It's not just a regular sale. Everyone's going to bid against each other, raising that price up. So essentially, you're going to pay tens of thousands of dollars more for that same property. Even though rates are lower, balance is going to be higher, or what you're going to mortgage is higher, which is going to equate a higher mortgage payment, which could translate to the same payment you would have had at that higher interest rate. The catch is you could refinance that rate to a lower one and save money. If you already buy when rates are lower, but you're financing more because you overpaid, you're stuck. You can't do anything to make that payment lower unless you hit the lotto and you could pay it off or take a huge chunk off that balance to lower your payment.
Right. No, that seller's there for a short period of time. Now, once you purchase the house, you give your money to the seller. They take their money. They're gone to wherever their new destination is. But they have that price, that sales price, and that principal balance now doesn't change. We can't go back to the seller and say, "Hey, the market changed. I need a refund."
Exactly.
But, that's refinancing. No, that's the purpose there. Refinancing that, whether that's, I know you work on several different methods or opportunities with refinance, but whether that's pulling out equity, whether that's changing the interest rate, whether that's changing the loan terms, just kind of restructure that.
Exactly. And right now, with all this newfound equity, we see that folks have racked up some debts. Obviously, when you purchase a home, you need furniture. You're going to do some mild renovations or whatever the case may be. So you rack up credit card debt. So as the Fed raises rates, that affects short-term debt like credit cards and whatnot. So we found that it's cheaper to refinance to a higher interest rate. Let's say you have a 2 or 3% from a few years back. It's cheaper to let that rate go, pay off all your debts, bundle it all together and have a lower payment overall than it is to pay that low rate plus all your debts. And then again, you could always refinance that back down at a later date. So cash out refinances have become super popular right now because it's monopoly money, right? Everyone's got all this extra equity that they never expected to have. So put that money to work for you now versus the opposite.
And something about kind of that rate itself, and this ties into that. People look at the mortgage rates and they're used to, and this actually happens with my generation, the millennials. Since I was in college, looking at mortgage rates, hey, rates are at 3.75%, 3%. Pandemic hit, rates went down to 2.5%, 2%. So my entire adult life, that's what rates have looked like. Now all of a sudden we're talking about 5, 6, 7% mortgage rates.
Correct.
So one, we were spoiled, and millennials is just odd timing of our entire adult lives. We've been spoiled. Those rates, lots of experts are saying don't ever count on that 3%, that 2% again. That was kind of a weird fluke, and it took a global catastrophe to make that happen.
Exactly. And then you have folks that also during the pandemic, some folks that you and I have even worked with that thought it was a bubble and it was going to burst and property values were going to drop at a rapid rate and more foreclosures would hit the market. Now we're 2 years since that point in COVID when everyone thought that, and rates are higher, prices are higher, everything's more expensive. So nothing's gotten better since COVID has ended. And I think this is going to be the new way real estate's going to be for the foreseeable future. We're not going to see a huge influx of properties hit the market. That's going to cause the market to adjust. If thousands of homes hit the market tomorrow, prices would decline because there wouldn't be that bidding war any longer. But to your point, folks holding on to that 2 and 3% rate aren't really eager to sell their property today. To take a 7% rate and a property that's 80 to 100,000 more than what they have now. So it's cheaper to keep their present property. So we have inventory issues as a result.
No, definitely. And then with that, the mortgage rate, kind of looking at historical context, we're actually sitting right now at a historical average over the past several decades. No rates, I forget the official average. No, but 7%, no, that's right in the average mark. So that 2 and 3% kind of spoiled us all a little bit.
It's an anomaly.
Look at even the bigger picture, like you said, the refinance, but looking at your credit card interest rate, your car loan interest rate, 6 or 7%, no, that's an absolute steal. And that's where you can use your equity from that refi, and they'll help you with that, lower the interest rates on everything else.
Agreed. I never focus on interest rates. When I talk to a first-time buyer, a move-up buyer, someone that's bought dozens of homes over their lifetime, I always focus on the bigger picture, which is what's it going to cost you out of pocket and what's your monthly payment going to be? At the end of the day, whether you have a 2% rate or a 12% rate, if you could find a home that you're seeking for a payment that you're comfortable with and could afford, is the rate really going to matter at that point? That used to be the case. Now with property values going up and rates being higher, the average first-time home buyer just cannot afford to have the payment that they're going to be comfortable with and actually buy a home, right? Especially in our market in South Jersey, the 100 to 150, even anything under 200 is non-existent any longer. So for a first-time buyer just starting out, it's pretty tough to go buy a $300,000 home and have $8,000 to $10,000 in taxes and be able to live a comfortable life from there. So it's a struggle.
Mm-hmm. So I want to bring up, we do have one question. Reminding everyone, feel free to hop in at any point, drop whatever channel you're watching on, feel free to drop a comment, and we'll do our best to answer it. So quick question. My rate is 2.875. I'm going to rent my house, but I have lots of equity in my home. Is there any way to use my equity without having to change my rate?
Yeah, I mean, if you have a ton of equity, you could always look towards a second mortgage, a fixed second or a home equity line of credit, and use that line to purchase another property. Now you have to figure out what that payment's going to be on that second loan, whether it's interest only or not, because some lines of credit are just interest only. So your payment's really low, but your balance isn't going anywhere. And then you take that payment on the 2.875 plus the payment on that second mortgage, that's going to equal your total debt. And will you qualify to purchase another property with having those two payments?
Got it. No, a lot of that too. Everyone's in a unique situation. What their income is, how strong their need is, to move, to make, pull the equity from the house to purchase that new property. So definitely, I can certainly have the initial conversations with anyone looking to purchase a home, what the mortgage market's like, what the real estate market's like. But it's not too long into my conversations with people saying, hey, you need to reach out to a mortgage advisor, someone who really knows, the mortgage market, and they can match that with your situation, and kind of dive in. What's going to work best for you and your situation, because there's certainly no apples to apples, no one size fits all.
Exactly. It's like a fingerprint, right? There's no two that are unique in a sense. So you have to look at it from a fresh lens every single time and figure out what that one individual's situation is. And it's always case by case.
So speaking of which, I talk to people, call me up saying, hey, Nick, I saw your sign. I saw you around town. My boyfriend and I are ready to buy our first home. What do we need? So I have the initial conversation with them, know what they're looking for, how soon they're looking to move. But again, like I just mentioned, I refer them to you, to a mortgage advisor, saying, all right, you need to talk to somebody, get a pre-approval letter for one. Now, for many reasons, but one is the speed of the market. The house that you saw today, someone just sent me a house today. I'm like, that's great. Offers are due on it tomorrow. So for better or for worse, but no, I sent them to a mortgage advisor to have that conversation. What are you having in that first conversation with the home buyer to find out their situation and how to help them moving forward?
Yeah, so we the way I do it is, especially in this market, to your point, everything's moving so fast. I stress on we need to do what an underwriter would do, which is gather all the documents and review every piece to make sure that they are going to be fine without a shadow of a doubt. One step further is we send them into underwriting for full approval up front initially. So it's no longer a pre-approval, it's a fully committed underwritten client. But the conversation basically is just educating them on the market, how it works, some creative ways to get their offers accepted, like appraisal gap coverages and things of that nature. Just having that initial conversation with financially where they need to be and what they could do to look more attractive on paper.
I know a lot of your conversations too. Those you can talk about a 3% interest rate, a 7% interest rate. I'm looking at how much I make a month. I'm looking at my bank account. I'm like, where does that interest rate factor in? I know you do a lot on monthly budget because for all of us, no, like you said, unless we're independently wealthy or lottery winners, everything comes down to a monthly budget and what your
Exactly.
family can afford and how that intersects with your wants and needs.
Exactly.
I know you do a lot on that end too. Of all right, what's the monthly payment you're comfortable with, and what are you looking for in a house? And that's where you and I kind of match up. All right, this is their monthly budget that matches this mortgage pre-approval, and then we're going out finding the house that fits that.
Exactly. My question every time, regardless of when they ask, what am I approved for? What's my max? I personally do not care what the max is. Neither should you as a buyer. Your max is going to be what you set it as. So if you're looking for a $2,500 payment, we're going to reverse engineer it and find out what price with what property taxes is going to yield that payment that you're comfortable with. What also goes into that question, it's two-sided. How much are you willing to pay monthly and how much are you willing to part with at settlement, which includes down payment and closing costs. Those are the two things I must know to point you in the right direction, because I don't pre-approve someone on their max. I pre-approve someone based on where they want to be personally. And sometimes folks frown upon that, buyers that is, because they want to know what their max is. But you and I both know it's not a race, right? Where you're not going to get a prize if you qualify for the most out of the bunch, right? You want to be put in a position, and you want someone to care about what that position is, so you're not going to be house poor. At the end of the day, if you're a first-time buyer, you still want to go out to dinners, you still want to go out on dates, you still want to buy yourself something and go on vacations. You don't want to just make that mortgage payment every month and be miserable at home. So we want to make sure we set you up to enjoy life and own a home, not just own a home and not get to benefit with everything else. Just go to work and come home. That sucks too.
Which is funny because it brings back. So my mom has given me lots and lots of great advice over my lifetime. But I remember it stands out now her telling me about mortgage guys and getting approved for a mortgage. Now they're going to approve you for this high amount, whatever they approve you for. Like that's not what you can spend because that'll max out everything, and then you'll be doing that. You'll be living in your house and nothing else because you'll be paying for it. But her experience at that time was pre 2008. Was a different market. I find it very interesting to work with because we work with first time home buyers. As well as the second property, whether that's move up or move down or purchasing a second home. There's lots of people that I know you and I have worked with who haven't bought a home in 25 years, who are very surprised at how different the process is from when they purchased their first home to what they purchase now.
It's shell shock because they think that you could just say, I'll take that one, sign on the dotted line, and that's it. Now, there are background checks. There are fact checking your documents, bank statements, pay stubs, tax returns, W-2s, all this stuff that wasn't needed pre-2008. So it is extensive, but also it's coming from a good place. At the end of the day, banks are perceived to be the bad guy, but ultimately they're just protecting their investment in you, but also protecting you from hurting yourself with that investment, right? Because we don't want you to borrow more than what you could really afford. We want to make sure that you buy that home and you are able to pay us back selfishly, but also not miss payments, not put yourself into a financial situation that you may not be able to come out of. Too many folks did that in the past. Just because you could buy a home doesn't necessarily mean you should. Just like a car, some people could go out and buy a Lamborghini for $3,000 a month. Should you?
Mm-hmm.
Probably not, right? But they'll lend you the money to do so. So that's what lending has become. Banks are frowned upon for, you need all this. I can't believe you're asking me for all that. That's none of your business. But on the flip side, when you're asking someone to borrow a couple $100,000, they have to ask, are you going to be able to do this? And there's no common sense there. It's all black and white, what's on paper, and they make their decision that way. But guidelines wise, like you take FHA, for example, debt to income ratio, the maximum ratio is 56.9% of your income. We just look at what's on your credit report and what that new mortgage payment's going to be, taxes and insurance and whatnot. We don't think about, or we don't ask what your cell phone payment is, what your insurance payments are,
Mhm.
what else do you pay for, childcare, so on and so forth. So there's other debts that someone has that aren't accounted for in a mortgage approval. So that's where the question comes. What can you afford? I don't know what else you pay and what other bills you have outside of what's on credit and what this new property is going to cost. So my question to you is, can you afford this? And only that person could answer that question. I could only tell you if you qualify, but making those payments, I won't be there to cheer you on as we go.
Right. No, I think that's definitely something that's changed over time. And honestly, it's something that you personally, and possibly it's all of any Mac, but highlight even more so. But hey, what do you afford? We're going to find the house that works for you. No, we don't want to get the deal done. No, we want to get you set up for long term. What's going to work for you? What's going to work for your family on there?
Exactly.
I do have to say on the front end, I've gotten lots of feedback from client. Is no, any Mac requires a lot more paperwork up front than some other lenders you can find. Spoiler alert, you can go on. There are certain websites where you can go online. You can enter in some of your basic information, and you're going to get pre-approved for a mortgage right there. I can tell you, working as a buyer's agent, a listing agent, the chance of having those, one of those pre-approvals from online spit out, the marriage license you got online, or the what do you call it, the license to marry people online, that's worth more than that pre-approval on there. At least
Agreed.
action. So working with Pat, and like I said, we've worked with over 30 different clients. We've never had an issue pop up where there was a surprise, where there was a debt we didn't know about, a situation we didn't know about that we had to lose a deal that the buyer had their house set on. So it's definitely a lot more with paperwork with our front, permission to run your credit score, providing those bank statements, tax returns. And I'll be upfront, working with Pat, it is a little bit more than two. But once you have that pre-approval, then you're solid. You can go find that dream house. We can be very competitive on that, which we're going to talk about in a little bit. But once you're under contract on that, we can move forward and get you into that house.
And the secret is, right, where we only lend the money. We do not make the rules. Fannie Mae, Freddie Mac, FHA, USDA, whoever the entity is for the type of financing you're using, those are the rule makers. We're just following them. We ask for a lot up front, but you're going to get asked for those same items once you're under contract. But when you get asked for them once you're under contract, it may be too late and you may no longer qualify as a result. So it's not that we ask for more. We just ask for it up front before we make a decision. Because the last thing we want to do is tell you yes, you get excited, find the home of your dreams, and then I have to make that phone call and shatter those dreams, right? That's not something that I want to do. I'm in the business to help people. Honestly, it pays the bills and whatnot, right? We all do this as a career choice, right? But my gratification is that settlement, that closing, where you get to see tears in people's eyes and people smiling and excited. I never want to see someone crying and upset, right? So that's why we do what we do, and it's coming from a good place, whether you want to believe it or not as a buyer. But you're going to get asked for the same documents no matter what. We just do our due diligence up front. But to your point, once I say yes, we're going to closing unless something catastrophic outside of anyone's control happens. But other than that, it's solid.
The other thing I appreciate working with you is there's lots of estimates, lots of numbers that are in flux through the transaction. And before you find the property, once you find the house, I do appreciate that when you give estimates to our clients, you always aim a little bit on the high end. You may not say that, but no, hey, here's the estimate. And then there's always surprises on those numbers, but all those surprises, because you give the higher estimate, are always that pleasant surprises. Hey,
exactly.
I estimated that you need to spend $1,500 on home insurance. It actually came in less. No, I estimated the rate was going to be this. It actually came in less. So it's great to give those little wins and pleasant surprises rather than somebody else who's going to give all the lowest possible numbers and say, oops, sorry, we can't keep that.
Exactly. A lot of people are scared in my industry, on my side, are scared to tell the truth up front. And it's a shame because someone's making a big decision and spending their hard-earned money, sometimes their entire life savings to purchase a home. So just be upfront and honest with folks from day one. Don't be scared to give them sticker shock because that sticker shock is reality. That number is going to be the same no matter who you work with, plus or minus a few $100, right?
Mhm.
Unless there's someone that's completely taken advantage. But the government has systems in place to prevent that from happening. So don't, like, some of these online lenders won't disclose property taxes, escrows, and things of that nature. They just disclose title and their fee. So their closing costs could be half of what mine would be. But once you factor in the rest of it, they're really the same, if not more. So if you paint the entire picture and you educate them on it, then you're ahead of the curve. But unfortunately, as humans, and I speak for myself as well, we sometimes want to be lied to, and we look for the best deal on the streets. And sometimes the best deal, the cheapest deal, isn't the best deal. Because at the end of the day, if the closing costs are less and the rate's less, but you can't get to the finish line, it was all for nothing.
Exactly. No, it's all made up. Until you're closing, you haven't spent very little, in rare occasions that you haven't spent anything to get to the closing table. So when you
Exactly.
get to that point,
Exactly.
you haven't lost anything.
Exactly.
So I want to touch base. The mortgage industry is full of acronyms. So you mentioned a few, but I want to talk real quick about the different loan types. So FHA, VA, conventional. Some people might be loosely familiar with these terms. Can you give kind of a brief overview of what those mean?
Yeah, so conventional basically is your Fannie Mae and Freddie Mac loan types. It's for the lack of a better term, it's better credit, lower debt to income ratio, reserves, and whatnot. So conventional is what most folks strive for, especially in today's market. In the hierarchy of offers, conventional is going to be the second best under cash. Then you have your government programs. So when we say government, we mean FHA, VA, and USDA. They're all governed by HUD and the federal government. Different rule makers, but really the same in the bigger picture. FHA is super lenient when it comes to debt to income ratio, acronym DTI. That's basically your income divided into the debt, inclusive of your mortgage payment, your total monthly payment. They are more lenient. So a fan favorite for first time buyers is FHA because you need less money out of pocket. You can make less money and qualify for more over a conventional loan. USDA is more for rural areas. It is governed by income. So there are income limits with it, and it depends on the household. It's not just the individual on the mortgage, it's anyone living in the home with that buyer that works. They would have to disclose their income. So if you make too much, you'll be disqualified for that program because USDA allows no money down and no mortgage insurance. So it's a huge program. And then you have your VA loan geared towards veterans. So you would have to qualify for VA financing. Again, no money down and no monthly mortgage insurance. Now, VA's rules are very loose as far as debt to income ratio is concerned. So I've closed transactions upwards of 60% DTI, which is unheard of. But if it works, it works, and they'll insure that loan. So, we always put it together and try to see what we could do with it.
Definitely. I know we've worked with almost all of those loan types. I know a couple of misconceptions that you and I both run into. One is FHA is not the first time homebuyer assistance or first time
No.
loan. I know that comes up because, like you said, it's very attractive for first time home buyers. And that's the intent of the program, is to help with the affordability and help people get into their first home. But I know we work with several clients that are FHA borrowers that help them get into their next home, help them get into their new home, but not necessarily first time home buyers.
Exactly. I've done many of transactions for move up buyers for FHA, and there may not be something negative as a result. They could have just had a bankruptcy um, that FHA allows to transact with that type of financing with less years from that discharge date than conventional would be. Same thing with a foreclosure. Again, lower credit scores, debt to income ratios, limited funds. So FHA is not always coming from a bad place. It's just the customer may not be able to afford a conventional loan, or conventional just costs that much more per month. So it's actually cheaper for someone to use FHA financing and either buy a better home or have a lower payment. So it's not always a bad thing for FHA financing. It's a shame because FHA financing was always frowned upon, but not as bad as it is today since COVID. I think it's easier to get denied a conventional loan than FHA at times, given the situation. But the market speaks that FHA isn't the best type of financing. But I disagree a lot of times, personally.
No, we've used FHA financing, get a lot of clients into their homes pre-COVID, post-COVID. No, it certainly is a great product, and that helps people get into that home, or get in the same home cheaper. It's definitely a good option.
I haven't pulled it in a while, but I'd argue to say over my career, the 15 plus years I've been doing this, I likely have put more homeowners in their home using FHA financing versus conventional. Where in the past 2.5 years, it's probably 98% are conventional, 2% are FHA. I can't tell you the last time I closed an FHA buyer, to be honest with you. It's been months, which is unheard of. In the industry, usually it's been 50-50 for the most part, but now it's 98-99% conventional and 1-2% anything else, which is your USDA, VA, FHA, and whatnot.
No, it definitely speaks to the competition in the market.
It's tough. It's tough.
The other misconception, and this was a hard one for me to break to people, but for the veterans with the VA loan. So no, we both appreciate our veterans, as does everyone out there. The VA has a great product. One of the big taglines of that product is doing a 0% down mortgage. But I know we've worked with a couple of past clients who call up, usually not their first home, but they're looking to move or purchase a second home. Well-qualified buyers that say, I'm a veteran, I want to use my VA benefits, use the VA loan. It doesn't actually always work out to be the best option for them. And it's kind of hard to tell a veteran, like I did 30 years of service and I want the benefit. And I hate to tell you, the benefit's great in some situations, but it doesn't necessarily mean it's your best option that's out there.
Agreed. I take everything from the beginning, regardless. When we look at someone, in this case, let's say a veteran, if we identify that it's more cost effective to go conventional versus VA, I'm going to talk to them about it. Now, they may not want to hear it, right? They say, I'm a veteran, I deserve VA financing. But once you break it down, the VA does have something called a guaranteed fee. If you use it more than once, that fee increases for subsequent use. If you're not exempt from that funding fee, it costs you tens of thousands of dollars to your mortgage, which is going to increase your mortgage payment to use VA financing. So if you have a move-up buyer that's selling their home and they have the equity and they're able to put 5, 10, 15, 20+% down, and they have to pay that guaranteed fee, it's not the best option because you're just spending money that you could put elsewhere. So then at that point, conventional is going to be better for you financially. Forget about the market and what sellers want to see and what's more attractive. It's just what's doing the right thing for the veteran or for anyone at that. Thank you for your service, but please let me help you put you in the best financial position. And sometimes that is not VA financing, unfortunately. But if you explain it right and tell them and show it on paper, it's plain as day which option is going to be the best one. But if they still want to go to VA route, by all means, at least we explained it and we allow them to make that decision.
Mm-hmm. No, it's definitely one of the most common misconceptions of VA is that it'll always be best. I run into.
And that you need zero money and no closing costs. That's a big one to overcome. And I blame some online lenders. We'll leave them nameless, right? But they don't explain the closing cost factor and that a buyer does have to pay something out of pocket, right? A lender is not going to pay your closing costs. Sellers aren't any longer, right? When was the last time we had a seller's assistance outside of a property needing repairs? Mm-hmm. So on any given transaction, a veteran may need 7, 8, 10 plus $1,000 in southern New Jersey for closing costs. And that's a sticker shock, because if they come to me after speaking to someone else that didn't explain that, once we let them know how much money they need at settlement, they think we're trying to get over on them. Like I'm trying to get over it on them by telling them this, but the reality is they were misinformed and miseducated the first time around, and they're always going to remember what I said, human nature. We want to be lied to sometimes, right? For the better deal. They think that this lender has this magic program that requires nothing out of pocket when everybody else is trying to make money off of us, which is not the case.
Mm-hmm. So I want to shift gears a little bit. So we talked about the best time to buy real estate is yesterday or today. Mortgage rates where they're at, the opportunity to refinance in the future. Overall real estate's like the stock market, but it builds equity, it builds wealth over time.
Over time, yep.
Someone's looking to buy a house, not necessarily tomorrow, but 6 months or 12 months from now. What tips do you have for someone who's maybe they're about to get married, they're about to expect that first child, they want to buy the first home? What kind of tips, suggestions do you have now, a couple months out, on how to best prepare for that?
Best tips are, let's rip the Band-Aid off and take a look. Let's make sure your credit's adequate. Let's make sure your income's adequate. Let's see how much money you have saved up. Let's formulate a game plan for 3, 6 months, 9+ months down the road as to what you could do to better prepare for it. Because like we talked about in the beginning of the call, it's not vanilla and uniform and cookie cutter anymore, right? Like the square, it's a square in a circle, not a circle in a circle anymore. So you need more money to cover appraisal gaps and get more creative. You need to overlook inspections, and you need to be conventional. You need to do so many things that you didn't have to do in the past. So let's identify that now. And if you're not quite ready, let's talk about what you could do to get there sooner rather than later. And my favorite is, we're not ready, and we have a client right now, right? A huge home run. Said client came and said, we want to buy a house in minimally the next 12 to 18 months. Let's see where we're at now. We took a look at it. They realized that they're more than qualified, and they're under contract, and they're closing in a couple of weeks. 2 months ago, or not even a month and a half ago, the client said, we want to buy a year and a half from now. And now they're buying 2 weeks from now. So some people just don't know. So a lot of lenders here, they're not ready to buy now, I don't want to deal with it. Versus let's look at it in the future and see what we could do today instead of the future, if that makes sense.
Absolutely. I think you and I are both on the same page of, we'd rather get that call 6 months ahead of time and talk to someone to say, hey, I want to buy a house in January of 24 and have that conversation. Rather than somebody call us January 2nd of 2024 saying, hey, I need to buy a house next month. Here's all my info. And we have to break some bad news. Hey, now you got some.
They don't qualify or whatever. Exactly. So I never say no, right? I have a team in place that's like a well-oiled machine. We take a look at it, we put it together. If they're not ready, we put them in a follow-up system, whether it's credit repair, whether it's savings. And we constantly are in contact with folks to make sure they're doing what they're supposed to do to get there. But in the meantime, we're also adjusting them with the market. If rates go up or down, that could change the dynamic. So we need to let them know, right? If there's a new program that comes out that could help them, they may be able to fast track that approval today versus 6 or 8 months from now. My world is forever changing, and there's some awesome products coming out that we'll definitely do another stream on that's coming from the agencies, Fannie Mae, Freddie Mac, and whatnot, geared towards first-time buyers and making them more qualified. That's something I definitely want to talk about once I know more about it. But that's something that someone 6 months ago could have benefited from, but it wasn't there. But today it is. So let's get you going. Let's talk about it now versus forgetting about you, because you just weren't ready to buy at the moment.
Yeah, definitely. No, like I said, you'd not rather have that time, that conversation, that heads up. I can promise everyone out there, no, we're not being self-serving as, hey, call us first, no, right away before. Nobody's perfect. I can definitely speak for myself, maybe Pat as well. We are terrible at being that spammy follow-up type person.
Absolutely.
Pat says, no, we're good at the check-in, saying, all right, we have this plan, no, and we'll help you along with that plan. And I think we're both best on, hey, the client in front of us saying, I want to do this, and we're ready to jump in. But no, the drip campaigns and that harassing people, we're both terrible at it. Maybe that's a good thing.
Exactly.
But no, the in all honesty, then the best clients are, and I call them the best clients because you said we're in it to help people, and these people can help the most, who call us up saying, hey, in this time frame, I want to buy a house. Where am I at, and what do I need to do? Sometimes the most difficult clients are, hey, I just saw this house. Offers are due tomorrow. I need you guys to stay up all night and double time and get this through it. It still may not work. I definitely enjoy helping people. I like winning and being successful and helping people. But sometimes we need a little bit of time for that conversation to get that set up right.
Agreed. And sometimes, like I said, it's not cookie cutter, and we need extra work. Again, we front load all the legwork as far as underwriting is concerned. Sometimes we need verifications of employment, and the employer takes 2 weeks to get it back.
Mm-hmm.
I'd rather get all that now, get them into underwriting, get them a full approval, and make them more ready to submit offers versus being disorganized and not ready, and then them fumbling every time and striking out when they're submitting offers, because that part sucks. That part's exhausting. You and I have had clients that just said, we're done. That's it.
Mm-hmm.
We're out, right? That gave up just because they were not ready enough for whatever this market is, right? And this market changes every day. So what you were ready for yesterday may not be today. So you need that team that's willing to fight, that deploys every resource that they have to get you to the finish line. And I think you and I do a great job of that. If we work together and stick together, we'll celebrate at that settlement table. But the buyer has to be willing to take that ride along with us. They have to want it as much as we want it for them. And if they do, rock on, man. We're getting to that finish line one way or the other. If we have to fight our seller for it, we'll do it.
I think we have. So last thing on the preparation piece, no, if you don't want to reach out to Pat, you don't want to reach out to me, you're not quite there yet. Maybe it's not 12 months out. Maybe, hey, it's 3 to 5 years. The general advice is certainly cash never helps you. Setting aside that monthly budget to save towards that purchase, whether that's going to be used to pay down debt, whether it's going to be used for your down payment and closing costs. If you don't know your credit score and what that looks like, take a look at it. There's links out there from the government. You can get the free annual credit report. Honestly, there's pros and cons. I use Credit Karma personally just to monitor. If you don't know what's on your credit, what bills you're paying, what might be past due, get one of those apps just so you're aware of that. So even if you're looking 3 to 5 years out from buying a house, that will always put you in a better position. Just being aware of where you're at, getting things out of collections. Paying down debt is honestly something I talk to the mortgage guy, talk to Pat first before you make lump sum payments on your debt, because it may matter what order you do that in, which ones you pay down. But saving cash, knowing where your credit score is, knowing what debts you owe are all good steps no matter where you're at in your timeline.
Agreed. Quick tips for that: pay your bills on time, pay them on time every time, right? And whatever your credit limit is, try to use 20% or less of that. Not having any credit cards hurts you. Only having installment debt hurts you. You need that revolving debt month to month. Even if you go out and charge a Happy Meal on it, do so and pay it off. Charge your gas every month. Small purchases. It lets the credit reporting systems know that you have the ability to charge something and pay it off on time and maintain low balances. To everyone's detriment is just, I'm living off my credit cards. High balances, high utilization equals bad credit or lowers your scores. The biggest thing, though, is paying your bills late. That's going to be the biggest thing that's going to affect the credit. But some people pay stuff on time and just are overutilized, and that hurts them as well. So low balances, pay everything on time, have a couple of credit cards, and credit will be okay.
Mm-hmm. So we talked about more towards the first-time home buyers know how to get started, kind of your first mortgage type setup. So we got about 15 minutes left. I want to talk about some of the strategies. The current market, we both kind of alluded to. We're short on homes. We got more buyers and homes out there, so it's certainly very competitive. So I want to touch base on AnnieMac products. It's only about a year old, I think. That you and I
We're actually approaching 2 years,
was it
believe it
2
or
years?
not.
Okay,
Yeah, because they piloted it on the back end before we brought it to market. So it's been about 19 months now, actively in the market.
gotcha. So time flies when you're in a pandemic.
Time flies, man.
But basically, AnnieMac as a company, no, I did have an opportunity to meet their CEO, who's a very brilliant person, the way he looks at things, his economics background on there. But AnnieMac as a company came out and responding to the market that we starting to see in 2020, 2021, with the cash to keys product. So we've now used that a couple times with clients. I won't get too much. I just want to give the brief overview. But in short, there's two different parts of that. The number one, and this is the part that I love the most, somebody calls me up saying, all right, Nick, we live in our house. We got married. We bought our house 10 years ago, a cute little, right in Deptford, West Deptford, one of those 3 bedrooms, 1 bath homes. It was great. We lived almost happily ever after, but we started having kids and dogs and cats. And now you notice you're in this under 1,000 square foot home and it no longer fits your family. So you got to move somewhere else. But the biggest question I have from buyers in that situation is, how do I buy a new house when I currently have this one and the mortgage that goes with it? So how to make that jump? So under this cash to keys, AnnieMac calls it the buy now, sell later program. And the second part of it is for someone who's not contingent on selling their house, but somebody who needs to be more competitive in the market, and that allows them to make cash offers on the property as a whole. So, Pat, I don't know how I did on that overview of it.
You did great, man. You did great. That's exactly right. And listen, I'm gushing because this program has changed so many lives, right? And since inception, folks were like, "What the hell is this? Is this real? What's the catch?" And now in our market, it is catching on fire. We get calls daily from random folks like, "I need this right now. Like, please help us because we're striking out." But you did a phenomenal job explaining it. Basically, Cash to Keys was created by my CEO, Joe Panabianco, and staff to contend in this marketplace. So he leveraged his cash and investors to back clients in cash, to submit cash offers, non-contingent cash offers. And the way we do that is, like I mentioned before, we put everyone through underwriting. That's something we always did, but crucial in this. So we put someone through the underwriting process. Once you're approved, we provide our cash offer letter, and you get to go to market and submit cash offers, non-contingent on a mortgage, non-contingent on a home sale, sometimes not even contingent on an appraisal if we get an appraisal waiver. So it is phenomenal, especially for those move up or move down buyers that cannot afford to carry 2 mortgages, do not have enough money for down payment and closing costs unless they sell their home. They don't have a shot in this market in competing with that contingency. So we actually buy the home for them, allow them to move in, and then you have 6 months to sell their property. Who else is doing that, right? And it's a game changer.
Definitely. No, I love on my end. Again, I want to help people, so I want to help them be successful. So I love having this tool in the tool belt to equip someone. I love the moment. So working with a cash to keys staff, once a client's pre-approved, they send me the notification, they send me their personalized pre-approval letter. But they also send me this proof of funds document. If you're not familiar with that, a lot of times we use it with investors, with someone who's making cash purchase. Now, if you're going to buy a house in all cash, you use a proof of funds rather than a mortgage pre-approval. It's a bank statement or a letter from the bank, verifying that they have that much money. But this letter I love from the cash to keys staff. I believe it states $2 million. So I say, hey, I'm the agent for John Smith. He wants to buy your house for $350,000. Just to convince you that he's qualified, here's a letter stating that there's $2 million available.
Correct.
At his disposal. Again, doesn't mean he's approved for a $2 million property, but that means he's backed. Sometimes people, I simplify it a little bit more. I'm like, look, Uncle Pat has a lot of money and he's going to back you up.
But that's the perfect example. It's look at Annie Mac Home Mortgage as your wealthy grandparents or parents that say, hey kids, go out and buy that home. If for whatever reason you get denied a mortgage or can't make it happen, we'll loan you the money to go do it, right? And now we'll buy the home for you, and then we'll sell it back to you, and we'll figure it out down the line. We are doing the same exact thing. We use the term unlocking the market, and what we mean by that is unlocking all that pent up equity that a home seller has that they cannot utilize unless they sell that property. But unless they sell that property, they can't buy the new home. So it's a catch-22. So we're unlocking that equity, putting that money to work before they even sell that property. Even for first-time buyers, right? I had a buyer that recently just closed. All they had was 5% down. That's it. 5% down, conventional financing, going up against the big guys, the 20, 30, 40% down, the cash buyers. How does someone compete with that? Because you as a listing agent will say, well, this guy's working with a lender that I know that does a great job, right? They're well known in this market, and their buyers are putting down 20%. This guy works with another well-known lender, does well I've worked with them before, whatever the case may be, but they're only putting 5% down. In your eyes, who's the seller going to look at more, the 20% down or the 5% down, right?
Seller's all about the money.
Now, if that 5% down submitted a cash offer, not predicated on them getting a mortgage, and someone else was 20% down, who's the seller going to look at, right?
Right.
That's where Cash the Keys wins. It helps folks that are struggling in this market win. And that's all we do is win. Like that song says, win, win, win every day.
So if anyone's looking online now, I know lots of people browse Zillow, other online real estate sites for fun. But do you ever see how property says back on the market? It's always in big caps. It's real estate law that those words have to be in all caps and they have to be front. But back on the market, buyer and financing fell through. It happens. It happens in any market. And a lot of times what that truly means, a lot of times is the buyer's financing, may or may not be the lender they're working with, but their credit score wasn't quite right. Their debt wasn't quite right. Could be a job loss, something that, and again, you can't necessarily control that job loss, but they're pre-approved for the mortgage. They had a good job. And tomorrow, if they work for a big tech company, their job's not there anymore. It happens. But a lot of times in this explanation to a listing agent, talking to a seller, saying this takes it off the table. If someone's submitting a cash offer on the property, the buyer could lose their job tomorrow. They've already been backed. Annie Mac's going to buy the house from the seller, and the seller's going to get their money, walk away from the table, move on to their next dream. Annie Mac's going to buy that property and work with the buyer to get them into that house.
That's exactly right. No matter what happens, we are on the hook for that property. So after the 10-day grace period for inspections and appraisals, if once required, passes and everything's good, and the 11th hour, we made a mistake, let's say, right? God forbid, we missed something where the buyer loses their job, makes a payment late, spends all their closing cost money or down payment money or anything crazy that could happen and has happened in the past. We step in and buy that property on closing day. We write the check. We now are the owners of that property. And yes, we will work with those buyers to make it right some way, somehow. We'll figure it out. But the seller doesn't care, right? They just care about two things. How quickly can I close? And when am I getting paid? So if we can guarantee those two things, that's all the seller cares about, right? Are you showing up at closing, and are you showing up with money? Now, whether that money is coming from a check, a bank wire, a mortgage, a duffel bag, they don't care. They just want the money. So if we can guarantee that payment on settlement day, there's nothing else to talk about, right?
No, and certainly with the buy now, sell later too, it opens up options. We worked with somebody who's relocating literally coast to coast, but it completely removed the need for any kind of temporary housing. Now, if you live in one spot and you're coming all the way back home to New Jersey, there's no way to feasibly do that without this or without a bridge loan.
Correct.
To cover that. You need to move out of one property to move into the new one to go sell the first one. It is incredibly stressful. Any real estate transaction, there's an element of stress now when you're packing up your life and you're moving to do something that big. So to have this product available, that's, hey, no, why don't we find you the house? We'll move you into the new house, send the movers to the old one, pack it up, send it all to the new house, and then we'll get you your old house on the market. The amount of
Huge
stress,
success story,
communication that removes.
And that's a real life example, right? Real life example.
So
from California to Jersey, we made it happen.
We did it, and they're doing the final closing next week, right?
Friday. They're
This week.
closing this Friday. Yep.
Something else that's really cool about this program is AnnieMac is actually not the first one to do it. The biggest question I get is, what's the catch? So from everything I put together, AnnieMac stole this idea. There's a number of other companies. I don't think they actually operate in New Jersey.
They don't.
But they operate in the West.
And the one is out of business now. They're not even doing it any longer. The main one.
Gotcha. So other companies came with this idea, and it is a good idea. They were not a mortgage company. They were not a real estate company. They were a third-party company that says, hey, we'll help you make a cash offer. We'll help you with the buy now, sell later type program. You just pay us a decent percent chunk of the transaction, and that's their profit model. That's how you make a profit. So not a
no
bad
matter
model.
what.
Maybe not a bad model, except if it's out of business, maybe it is. But with AnnieMac, the biggest question I get with this cash case program is, what's the catch? There is no catch. There is no fee for doing the program. This is AnnieMac's not so slimy way of getting your business. I think that's what it boils down to. But they're being unique in the marketplace in order to attract clients to them.
There's a lot of mortgage companies in our area, in the country as a whole, right? So, and everyone offers the same thing. Rates are rates. We can't control it, right? That's below all of our pay grades. Programs are programs. So what can we do to really, really help folks out there get into their home? And this is that. So there's no catch to it. We're not doing this for profit. Believe it or not, it runs at a loss 9 out of 10 times because we have a full staff to facilitate the contracts and help folks get approved and set up. We pay underwriters for it and processors and so on and so forth. So it's not for profit. It's to dominate the market and help folks transact. And that's why we do it. So there is no catch. At the end of the day, we're a mortgage company. We're providing you a mortgage. And that's the catch. We're transacting with you.
Exactly. So moving on for that, we got a couple minutes left. Touching base some other little bit difficult market on the buyer side. I just want to share my experiences with Pat. There is a lot of mortgage lenders out there. Pat was talking a little bit before about reputation. So I do any of my clients that Pat and I are both able to mutually help. You don't always see it on the buyer side, maybe on the seller side on that back end. But that ability to work with a mortgage lender, when I'm submitting the offer, I'm looping Pat into that conversation. A lot of times when we work with a client to build an offer, it's a 3-way call or a 3-way conversation. What the client wants to offer, Pat's on the numbers, how to make it work. I'm working on the more competitive market engine, how we put that together. And then Pat and I go presenting your offer together to listing agents. I think that definitely makes a big difference. Lenders are a dime a dozen. Real estate agents know that. They go under contract, someone has a pre-approved letter that's on pretty paper that all the numbers look good, but it doesn't matter until you get into the contract and through that. So that communication is key. I know a lot of times I'll submit an offer and Pat's reaching out to the listing agent to kind of say, hey, John Smith just submitted an offer on your property. If you have any questions on his pre-approval, I'm happy to discuss it with you.
We take it one step further now. We encourage the listing agent to call their sellers and let's do a 3-way call with them. I want to talk to the sellers. I'm the one paying for it in a way, right? My company is, right? Mm-hmm. So let's have that conversation. Let's talk about the client. Let's talk about the transaction. Let's talk about how we're going to get to the finish line. And once that conversation happens, usually that offer is getting accepted because then that seller knows who he or she is dealing with and that we're more than capable of getting the job done for them. Again, they want to close quick and they want to get paid. So we have to guarantee that in some way, shape, or form.
Gotcha. Any parting thoughts you had? Anything you wanted to share?
No, basically it's a tough market. My biggest thing is stay positive. work with a team that wants to work with you and wants to help you. It's not always about collecting a paycheck. It's about succeeding, and it's about seeing that smile on your face at that settlement table. So patience is key. Listen to your team and allow your team to do what they do best.
I think we might have just lost you right at the end there.
What's that?
I think we just lost you.
Yeah, phone calls started coming in.
Gotcha. No, definitely all good advice there. No, I enjoy working with you. I know we have a lot of same
Likewise.
values. The say we work with clients. Do want to point out I've used Pat for personal transactions twice now, and that's honestly big for me. I make lots of recommendations to title, to home inspectors. I'm very proud to recommend the same vendors I used in my own house, for my own family, for my own property, to share them with my clients as well. Pat is also very reachable as well. That's another thing I do like work with him. So I do have his cell phone number if anyone needs it. Text, calls. He's always great with questions. We're both of the same mindset of bother us anytime. Doesn't matter what your question is. Reach out. Hey, you got an equity question?
Anything. My personal cell phone number is out there for a reason. Use it. Call or text me anytime, nights and weekends included. We're here to work for you and like I said, get you to the finish line.
The last thing I want to share is I got Pat's website up there, patstaffa.any-mac.com. So there's tons of resources on there, kind of an overview of some of the stuff we talked about, the different mortgage programs out there, mortgage calculators. Pat has a lot. He's still outpacing me on the number of 5-star reviews, but you can see a few of them up there as well. And, of course, all his contact information.
Yeah, anything you guys need, just give me a call at any time. We're here to help. If you have questions related to qualifying, cash to keys, what can you do if your current lender isn't going above and beyond, or you just want to get a second opinion, that's what we're here for. And that's the catch, the second opinion. We're here to get you there.
Awesome. All right, Pat, thanks a lot for your time. I appreciate it.
Thank you, sir. I appreciate it, man. I loved it. Let's do it again soon.
We'll do it. Thanks, everyone, for watching. Appreciate it.
All right, guys, take care.